And we are live. Welcome, everybody. It's showtime, webinar time, Treasury Masterminds. I'm really excited about this one. We have a really cool topic here. Yes, cash flow forecasting, it has been talked about many times, but this time we do it differently. We'll put it on trial. We'll ask the question, is it still fit for purpose? Should we still spend our time on cash flow forecasting? Three amazing speakers here. Let me quickly introduce them. We have Maggie Wong, Group Treasurer at Alberts. I have Alexander, the founder of Clearbox, Treasury Consulting, and Treasury Masterminds board member. And we have Jürgen, Solutions Manager from Nomentia. Maggie will take the pessimist angle. That doesn't mean she's against cash flow forecasting. Very important to note that. Alexander will take the role of the optimist, and Jürgen will take the role of the tech angle and provide those insights. And you, the audience, you can be the judge. Tell us at the end, tell us at the beginning, tell us now. Use the chat if you still use cash flow forecasting. If you are keen to use it. And at the end of the session, we want to hear from you. Did we change your mind? Did we change your perspective? And are you pro cash flow forecasting or against it? We'll see. Or do you need the tech angle? So without further ado, let's start. If you have questions, please use the chat box at the right-hand side. We do see your questions coming in. We do see your comments coming in, and all the questions you ask. There's room, 5 minutes at the end, to ask audience questions, but there's also room to ask them in between and to provide comments there. I do want you engaged because I do like audience engagement, and we will start with a poll question as well. So do not lean back. Put your hands on the keyboard. I will ask a question soon. So let's start with that one. Let's start with a simple poll question. How useful is your current cash flow forecast? Of course, that's assuming that you do a cash flow forecast, but if you do, how useful is it? 1, very useful. 2, somewhat useful. 3, very useful. And 4, not useful at all. Please put it in the chat. 1, 2, 1, very useful, up till 4, not at all. And we will see your comments coming in. Maggie, what do you think? What will the audience be commenting here?
Generally speaking, I feel cash flow forecasting can indeed be very useful, valuable. The difficulty is that it requires so much effort and investment to make it indeed, to do it right, to get useful information out of it that, yeah, for me, I don't really make a short-term based for liquidity cash flow forecast because for me, it's not worth the effort.
Clear. We'll dive deeper into that later. I see a lot of 1s and 2s coming in. Alex, surprised.
Yeah, so once remind me and the audience.
One very useful, 2 somewhat useful, and I saw 1 3 barely useful.
Right.
No one is daring enough to boost 4, not at all.
Yeah, no, this is indeed. I was also expecting the audience to be a little bit more undecided, right? Because on one side, it's of course important to think ahead. Because the companies go bankrupt because they run out of cash, right? So not thinking about this is asking for trouble. Essentially, one way or the other, we all think about our inflows and outflows, how we're going to pay the bills, salaries, taxes, etc. Right? So yeah, it looks like the audience is indeed more on the ones and 2s. That it is useful, yeah. which is great to see.
No, let's see if we can change their opinion during the course of these 45 minutes. Jürgen, is this also what you're seeing with clients? it is
Yeah, I
useful.
mean, I deal with many different types of clients. Some that has already established processes and they're running well, but we also see many companies that they're where they don't have a good process, and they're struggling to get their liquidity forecasting in place. And I think there's also where technology can really help by helping to automate things, collecting data from different areas, ensuring the right quality of the data that's coming in, and so on. So technology can definitely help here by automating and standardizing processes, so you can do the liquidity forecasting without spending too much time on it as well. Because of course there's also the trade-off: how much time do I want to get into it, and what the quality I'm getting out of it.
No, definitely. So let's dive into it. Maggie, the skeptic, why is cash flow forecasting not worth the effort? You already told us. Tell us why.
Yeah, I remember very clearly as part of my first job in Treasury as a Treasury analyst, I had to do like the short 3-day cash flow forecast. And what it would mean, every morning I would contact all my colleagues in Europe, Middle East, all the subsidiaries to get their forecast about expected customer payments, what they expect to pay, collate all that data, and that would be a forecast. And then after that, I would spend looking back a lot of time saying, okay, but your forecast was off. Why was that? And there's never a clear answer. Even, for example, our own payments, which you are theoretically fully in control of, could not be adequately predicted. So on the customer side, of course, it gets even more difficult. You're hoping that your customers pay on time, on the due date on the invoice. That doesn't happen. You don't really adequately predict then when do we receive the money. So a lot of time is wasted on collecting information, collating it, and then looking back at, why was your predictions from yesterday or the day before not correct? So, but that is supposed to be actionable information, right? And where do I need to fund some extra cash? Do I have excess cash to put maybe on deposit? So if the quality of that information is not really good, you should not take actions on it. And that's for me why I feel, in this traditional form of cash flow forecasting, it's not really worth the effort.
Yeah, no, yeah, clear explanation. Alex, the other side of the coin, why does cash flow forecasting does make sense?
Yeah, I think there are two ways to look at this, from smaller companies' perspective and from larger multinationals, right? So I'm based in the Baltics, and I work with smaller companies as well. There's maybe 50 million or more revenue. Where finance director does treasury job, etc. Right? So in those circumstances, the process is quite manual, right? But they are essentially thinking, okay, will I be able to pay? Especially if you're not in a cash-rich business, right? You are looking ahead, trying to plan how do you meet your ends. With multinationals, there is also another angle of this, and it's on a very basic level. You need to ensure that there is enough cash in the right place at the right time, because with multinationals, especially, you typically have outflows in one part of the group, and you have inflows in another part of the group. And you need to bridge the gap through intercompany loans, intercompany equity movement, dividends, etc. Right? And this is where cash flow forecasting, we're talking about longer term cash flow forecasting up to 12 months, helps you identify where are those crunch areas, crunch periods, so that you can plan the activity accordingly, because things take time. To repatriate cash, if you're a US multinational, from Europe or abroad back to the US, that typically takes quite some planning, quite some activity involving accounting, legal, etc. So you need to plan ahead for that activity as well. And cash flow forecasting helps that.
Yeah, makes sense as well. Then, Jürgen, up to you. Two different angles. How can technology help, and do we need technology to solve this?
Absolutely. Yes, I mean, what I just heard from Maggie, surely that have you had a proper solution here that would actually go out to the banks, collect the bank statements for you, and should be then, without having to contact any local people, be able to connect and connect to the banks and collect all data information, so you can do your 3-day forecasting using the right solutions for that. There's definitely available now. I do not know whether you had such solutions in place, but it's definitely possible today to do a quite good and accurate 3 days forecasting, but also the long-term forecasting, if you have the right data and have the right quality of data. Of course, it doesn't help to collect lots of data if it's not good data. As I also understood from you, Maggie, some of the problems you had, the data was not very good.
We had a TMS, a very sophisticated one. All the bank statement, all the cash visibility was there, but it's about forward-looking 3 days. Yeah. So forward-looking 3 days, of course, not reflected in any bank statement.
That's correct. That's not in the bank statements, but then that information should be. You should be able to collect that data from other sources. Of course, on the incoming side is the most difficult, as you said as well. How to predict when customers are paying. But now I see more and more AI is coming in, and we probably be able to analyze the data in the past and do a better predictions, not just for the next 3 days, but also further into the future. So with technology and the right technology in place, it would definitely be possible to do good predictions.
Clear. So you're saying, Jürgen, you need automation. You need.
I said there are many things we need. We need automation, but we also have the right processes. Yes, it doesn't help to try to get the data if you don't get the right data, and if you don't get the right quality of data in and do it in time. We need to collect the right quality of data. Then with that, it is actually possible to do, in my experience, to definitely the short term, but also the long term forecasting in a good quality.
Mm-hmm. Yeah, no, clear. Alex, is that what you see? Is that the one success factor? Is data quality the number one?
Yeah, I would also say that data is key, and the way I would look at this, multinationals are in a better position because you do not depend on one single customer making a payment typically on time, right? So you can take a more luxurious approach where you look at everything on a high level, on a portfolio basis, and you forecast into the future. Someone pays late, someone pays early, but it kind of evens out more or less, right? So you can work on this basis most of the time. Not for all companies, not for all businesses, etc., right? But most of the time, corporate treasurers can do that, and that's what TMSs cater for as well, right? That kind of high-level forecast. But in order to predict the past, you need to figure out the future. You need to also have good knowledge of what the past was. So you need to spend some time on categorizing the data into homogeneous groups, so that then you can predict them more correctly, and so that you can also form the expectation of those categories. What is high level of predictability, high level of confidence? What is lower level of confidence? I think what is more difficult if you are a treasurer, or more often, especially here in the Baltics, a finance director of a smaller company where one customer or a small number of customers could actually make a difference, right? That's where predictability can suffer, because you really depend on when those people are paying you, right? And so you depend on them, which is also quite telling. It's telling you that, hey, if your cash flow forecast is that unpredictable, then maybe as a business you're way too concentrated with a particular subset of clients. So that's also kind of triggering another thought process as well. But I would agree with Jürgen. Data is a good starting point, and automation is enabler. It helps us work through that data, remove the workload from gathering the data to actually analyzing it, and more importantly, making decisions based on that data.
Yeah. But if you say it that way, it sounds very easy. Yeah, that data is the key success factor. I have some clients who have 4, 5, 6 ERP systems. You mentioned you need a categorization of your actuals. So first of all, you need all bank statements to be come in. Then you need the rule-based. I have one client who has almost 1,000 lines just to categorize his actuals. A lot of time was spent in. These were not set up in weeks. These were set up in years. So a small treasury team might struggle with that. Maggie, where do you see it failing? Is it really the data quality, multiple ERP system? Is it the time and effort spent on it? Or are we just overcomplicating things?
Data quality. So it really depends. Like, okay, what do we see as data set needed for cash flow forecasting? Like, for example, I have a TMS. Cash visibility for the entire group is basically more than 95% on a daily basis. So that's already very high. The key word for me is forecasting. It means forward-looking. That cannot, data quality is not relevant really for forward-looking. That's for me business input, knowing your customers, etc. And it's only a prediction. You do not control. And it can be a serious deviation based on what you expect. And I think AI can really help by looking at historical patterns in time, payment behavior from customers, or etc., help to make predictions in that. That is supposed to be, I think, big improvement, because depending on local colleagues who are maybe in accounting department, not necessarily in the sales department or in the credit department or anything. These people, of course, their core job and their core skill is not really about cash flow forecasting. So if you can take these people out of the equation by replacing that with AI, historical patterns, feeding it with a lot of historical data, I think that will improve the quality. And then for me, it will also be more worthwhile because it's relatively less effort, indeed for small treasury teams, but even if not for treasury teams, for a multinational, we are in many countries, we have 14,000 employees. I don't want anyone locally to have to spend time on this. If the quality improves, less resources needed, then it will be worthwhile. But where it fails is indeed also in these two areas.
No, clear. Small summary from what I've heard. So it's all about data quality. It's also about ownership. It's a bit about timing and predictability, but also a bit about the past and the technology angle, what I heard from Jürgen. So makes it a difficult combination there. But hey, I heard 3 opinions now. We have hundreds of people in the call. So let's ask the judges. I have another poll question incoming for you, for the audience. So be ready to comment, please. What is the main reason your forecast fails, your cash flow forecast fails? Is it number 1, data quality? Is it 2, the business inputting? Is it 3, the ownership of the treasury team? Number 4, timing, or number 5, over complexity, multiple ERP system. So again, number 1, data quality, 2, business input, 3, ownership, 4, timing, 5, over complexity. And please don't say all of the above now, because then you have the other issues. I heard a lot of data quality, ownership, and timing here. But that leads me to this one question, and I want to ask all 3 of you: is the effort required for forecasting justified by the output? I want all 3 to comment. Alex, you first.
Yeah, I certainly believe that it is worth it. But there was one thing that I would like to home in on, and that is in the way how you asked the question. Like, how do you determine when you actually fail at forecasting, right? So the big question for me: how do we set a benchmark of what a good forecast looks like, right? And I think this is where the failure starts. We often have, in my opinion, a wrong benchmark. We say, oh, it needs to be 95% accurate. Well, against what exactly, right? If your customers stop paying you and you miss forecast, then it doesn't necessarily mean that your forecast was wrong. It might mean that something happened with that customer bunch. Maybe there is something happening geopolitically, something happening that is beyond that, right? So if you're, what I would say the benchmark really is, if you look at your past, and we're talking about high-level forecast, right? So if you're looking at the past, you're extrapolating it into the future using, let's say, machine learning, you're able to capture patterns, seasonality, and formulate expectations based on what your business as usual looks like. That's a good forecast. When you perform actual versus forecast analysis, if you realize there is a deviation and you realize it's because of some underlying reasons that are not necessarily tied to kind of the way how you performed the forecast, it still means the forecast was okay, it was good. And I feel it's definitely worth the effort, because all of us in the business, treasury, the finance directors, business owners, we want some predictability. And going through the cash flow forecasting process gives us some sense of that predictability. Sometimes maybe a mirage, but most of the time I feel it's a good goalpost, a good marker for you to move towards.
Interesting. I see the poll results coming in. It's mostly about data quality. It's a bit about business input. I did see some timing thing coming in, a bit combination of both. Not many saying ownership and over complexity. But over to you, Maggie. I know the size of your team. Is it worth your effort? I already know the answer, but...
For me, at the moment, no. And it also has to do, of course, with how we have arranged our long and short-term funding. That's one point. And indeed, I have a small team. We also have multiple ERP systems within our group. So I'm only willing to look at it, start putting effort in cash flow forecasting, relying on the results, if there's a proper tools for it. So the classic or traditional way, as I described earlier, in my first job, how I did it, definitely I will never do that. So if we can do it in a smart and better way, then yes, because in itself, I think it's valuable. However, I just feel that in reality, it often is just not worth the effort.
Yeah, clear. Jürgen, we need you.
Yeah, I just noted down something you said. You had a customer who had 1,000 cash flow items. I think if you go into that detail, you use lots of time on it, and probably that's not worth it. Yes. Do you really get something extra out of having thousands compared to 100? Even 100, I think, is a lot. Yeah. So if you try to invest that much in it and then see what do I get out of it, no, it's not worth it. Yes, that might end up like that. You try to do too detailed, too complex, too accurate. Yeah, too expecting too much from it maybe. But I think with the right solution and with the right horizons, and I think we also now sometimes here mixing up the very short term, the daily cash management, and the more long term, the next 12 months, 18 months, that there are two different kinds of beasts. Yeah, I said these two different kinds of solutions and also two different kinds of data. So we also need to see what we're actually talking about here when we talk about liquidity forecasting, what type of it, and it needs different data, it needs different processes as well, and probably also have a data as a one is a very short-term process that has to be done on a daily basis. Other one might be done on a monthly basis. So we need to also be clear what data we have and what solutions we have for making those liquidity forecasts.
Mm-hmm. So mostly it's the traditional 13-week cash flow forecast. The more long-term usually comes from FP&A. It's not cash flow based. It's usually EBITDA based, P&L based. The time of the cash matters less.
You still need to convert your profit and loss forecasting, the sales budgeting into a cash flow, so you know where am I in 12 months. What's happening there? So you can do the right funding for your company.
No, correct. I see most technology vendors focusing on these short-term 13-week forecasts, beginning in daily basis, weekly, and then maybe a bit on the monthly. But the focus goes down for most treasurers on this monthly basis. How much cash do I have in 6 months? The room for error is quite big. So really focus on these 13-week. Yeah. No, makes sense. But Jürgen, which tools do you see clients using? Which tools do you see them looking at? Is it automation of ERP system? Are we ready for AI?
Is AI ready for liquidity forecasting is the other question.
Maybe fair.
Yes, AI is of course very much hyped at the moment. Lots of customers are asking for it and would like to see what is available now, what can it do, how can it help, and AI can definitely help in different ways. For example, also just not necessarily for the forecasting, but also just look at the data. Is where are some patterns, where are some anomalies. For example, incoming data, was that really right? What I got from that one subsidiary, or did they make a mistake in there? So AI can probably help you to improve your data, as we talked about earlier. The data is wrong, but it can definitely also now help to create the new categories as for the actual data to compare to the actuals and make those correct. If you don't have 1,000 items, probably that is also AI would fail because it's just too complex depending on what kind of data you have for it. So yes, AI can definitely help, and we see more and more AI being asked for and also used at customers.
Okay, no, very good. Alex, if you have to decide on is it worth it, yes or no, what's the minimum level that we need on cash flow forecasting? Can we say we need at least X amount of accuracy for it to work, or it needs to be efficient? Like Maggie said, it needs to be done in 2 hours a day. Where can we decide?
2 hours a day is already too much.
A week, let's make it a week, 2 hours a week. I agree, way too much. I do have clients who spend 2 hours a day on it, but off topic now. So what's the minimum? Can we agree on a hurdle where the audience can decide it's worth it or not?
Yeah, I think what is great that's coming out of technology these days is that you can achieve a result with much less effort, right? So that is what technology is able to do today. How it does it is a different question. We are talking about AI very much, but I've seen machine learning, which is a subset of AI, being a lot more impactful than anything else, right? And machine learning has been there for decades, right? So machine learning is very useful, and it can cut down your work by a lot. So I would say the very minimum requirement is that you should be able to sit down, feed the data in, and for the system to generate the first level forecast into the future based on the forecast horizon that you need. And in my mind, 13-week forecasts, or like few weeks ahead, 6 to 13, depending on a company, is a good one way to look at it. And another way that that is there in my mind is indeed like 12-month forecast, because that is very often needed for the board of directors to really show that they fulfilled their responsibilities from the director fiduciary duty perspective, right? So that's those are the two horizons that I would say you need to be able to get out of. If you're able to get there without spending way too much time, right? If you're able to get the first level cash flow forecasts at a click of a button, subject to your data being right, and essentially then you take a look at it and you say, does it make sense? And this is where your business knowledge, your knowledge of future plans comes into play. And you essentially, then you spend time on analyzing that and adjusting the forecast based on what you know will happen in the business, as opposed to crunching the numbers, right? So I would say first level should be done in a matter of, these days, minutes, right? And then you shift and spend a lot of your time on analyzing and adjusting the numbers based on what you know might or might not happen.
Yeah, well, that's an interesting take. Maggie, without a forecast, how do you manage your liquidity risk?
We have a defined headroom target, or minimum 30% of our available liquidity. So that's, of course, cash plus available credit facilities. And it's sized rather generously. Basically, our available headroom day to day is on average like 70% plus. So I don't have to worry too much on will we have enough money to pay all the bills everywhere and the salaries, and that my colleagues in the operating companies can pay their suppliers. I guess that's probably a very luxurious position to be in. I can totally understand that if you are super squeezed for liquidity, the value and the importance of cash flow forecasting becomes much, much more important. And basically, you run your company then really on cash flow forecasting very short term, because I know my peers, I have had some peers who need to decide, basically, we have this much in cash. Yeah, we need to decide, are we going to pay salaries, or are we going to pay tax, or are we going to pay these suppliers? That's, of course, a very different position to be in. I do realize that, how we do it at Alberts is a very luxurious position to be in.
No, but fully clear. I do see a comment in the chat from Gerd. In Germany, there's insolvency law that if you have a certain cash position or nearing insolvency, you have to, by law, provide a 13-week or sort of a 13-week cash flow forecast, updated on a weekly basis, and provided to the insolvency agency who's supporting you. So clear. So maybe summary so far. Maybe the question is not forecast yes or no, but maybe the question is how much and what purpose. So how much time do I spend on it, and why am I forecasting? For what reason? Also, given the resources in the average treasury team, which is fairly small. But for that, Jürgen, I would need you again, because the average treasury team, it's a small team. We did some research lately. On average, 2 to 4 people is a treasury team, even of multinational organizations with big turnovers. So we are stressed on workload. We can't spend 2 hours a day on this cash flow forecasting. So we need help of technology. Maybe, do we need AI? Do we need to fully automate our cash flow forecast, or do we just simplify it? I like Alex's solution. Pushing a button. Is that realistic?
Yes, I like that as well. So so first of all, I think make sure you have set up proper processes for your collection of your data. Yeah, that may not need AI. You just need to collect the data from the 80% of the business that is most important. Maybe you don't need to take the subsidiary the first away for their one bank account. And make sure you get the majority of the data together in one place. Yes, you need to connect to different systems, but it's not that difficult to extract some of the most important information, like invoices, which invoices are in the system. But again, it requires a proper process that invoices are in the ERP system. If they're not there, you cannot find them there. You cannot get the data you need for your 6 or 13-week forecast, as you were suggesting before. So yes, we need to collect the data. We need to have proper processes set up to do this. And this also technology processes that certain jobs are running in the ERP system to extract the data to send to the ERP, to the treasury system, so you can actually have the data available. And that's not necessarily anything to do with AI. It's just normal technology interfaces, processes, and so on. And then once you have the data, then we can start using AI to as I said, analyzing the data, finding exceptions, and also try to use AI to do the forecasting itself.
But maybe if processes, systems, make it efficient, automated, that's all agreed. I just explained that in Alberts, I'm quite in a comfortable position. So that's why for me, cash flow for, let's say, the short-term cash flow forecasting is less important. But of course, other companies where things work differently, they have a different cash position, different funding structure. It is much more important. If I would, for example, work in a company where cash is super tight and I really need on a day-to-day basis know where my cash is, how much cash I have, whether I have any headroom left, that is first a key question. For your business, how important is it to have it? If it's less important, of course, it moves down the priority list. For me, cash flow forecasting would only be like marginal improvements in how we currently today manage our cash and our liquidity. In another company, it's crucial. Then if it is crucial, of course, you spend more effort on it, and then you design a process and a system to make it as efficient as possible with the best quality and actionable data as possible. So there's no thing like, oh, cash flow forecasting is good or bad. You have to decide whether it's good or bad or crucial or not for your situation. And then, of course, like any good treasurer I know, we try to make it into a process with the right tools to make it work as efficiently as possible, because all treasury teams are squeezed for resources. You try to have good data quality, good processes, and good actionable data. I think that's the key with cash flow forecasting, same as all other responsibilities that fall under the remit of a treasurer.
Yeah, no, nice addition, Maggie. Fully agree. I have a next question for you, Alex, and it's related to the question of Ali. How about scenarios? Accuracy is one thing, but then Trump comes in, wars come in, the world changes one day after the other, especially in these times. The forecast of yesterday can be bent. We need to rework on the forecast. Is that how it works, or should I have had 3 different scenarios yesterday in my cash flow, an optimistic, pessimistic, worst case scenario, and forget about the accuracy at all?
Yeah, I think the reality is that we live in a world that changes every day, and that's pretty much it. If you look back 20 years, we had the financial crisis, we had the Euro debt crisis, we had Crimea annexation, we had the war in Ukraine, now the war in Middle East. You have so many things that are happening out there. You cannot plan for them all. If you try, you will probably lose sleep, and at some point might lose your mind, right? So you only forecast based on what you see happening in your business and try to forecast based on that, try to forecast the future. Maybe you take into account some very dire scenarios like, I don't know, Brexit planning, right? Especially like it was a thing around foreign exchange, right? What will happen with the rates? So maybe those are the things that you take into account. If they have huge impact on your business, then you try to simulate what will happen. But in general, I would say, hey, don't try to forecast for each and every single scenario that is out there. Life has a surprising tendency to surprise you and find other ways to throw challenges at you. Yeah. And I also wanted to reflect at one thing that Maggie said about the cushions from cash perspective. Those are great, but one lens that I would look at it, one perspective, is opportunity cost. Right. So what is it that my cash doesn't do while it sits on the bank account? Right. So one, it's not earning interest, or it's earning less than it could have earned with investment longer term, potentially. And then secondly, it also incurs bank fees. And one of the bank fees that I see through the bank fee analysis project that I'm working on is insurance charges, deposit insurance charges, right? If your cash is sitting on the bank account, then it is incurring those charges that are passed on to the client as well. In the past, we were also seeing negative interest charges on euros. Thankfully, we're out of that territory at the moment. But then the other opportunity cost, hey, you could have potentially earned more, right? So and that's where you can start looking at, okay, how do I manage all that, right? How do I increase the yield, and through that tell the story? And let's be honest, if the average is 2 to 4 people in a multinational treasury team, by increasing the yield just a little bit, you probably will pay for the whole team, right?
Yeah, no, fully agree. Treasury can be a moneymaker, but if there's no budget, decisions have to be made. What can I do in these 40 hours I do have? We do have 5 minutes left, so audience, please keep the questions coming. For the panel, I only have a few questions left. Jürgen, let's look into the future. Where do you see cash flow forecasting go into the future? And maybe technology improving?
Yeah, again, we talked already about it many times. The AI is what everybody's talking about now, and many are asking for. But I think I've been in this business a long time. We also always talk about improving liquidity forecasting using the technology that is available, like in integration to get the proper data, have the right processes, and so on. It's not that this has changed a lot over the last years, except now the AI is coming in where that can really help to improve the forecasting, I would say, primarily, and identify the data that are not correct. So that it would really help us, and to help also find out what are the liquidity, the cash flow items in the past, etc. For here, that's where the AI can probably help us. It is to improving the data and improving the forecasting, not so much the integration, not so much the processes. They have to be set up by the Treasury Department. And that has been like this all the time for a long time.
Yeah, no, it makes a lot of sense. There's an audience question. I think it's also good for you, Jürgen. The process to understand the actuals, is it really mapping the bank statements for each subsidiaries with rules to a cash flow category? Or are there better solutions for it?
I mean, there are basically two ways of doing it. Either you just take the information that's only available in the bank statements, and then it's of course limited how much you can do. You can definitely not get down to the 1,000 items as you talked about before. Or if you want to have more accuracy, you need to go into the accounting or ERP system to see, okay, I have a bank statement here. Here's the invoice, and I can drill down and look at the line items. Where were they actually posted to which GL account were they posted? Then you can get into a much more detailed item. Then you could potentially get to 1,000 items, but it's lots of effort to set that up, and lots of exceptions always to consider when you do that. So I think you would get in most cases enough if you have less than 1,000 items by looking at the bank statements and make sure you use all the information that's available in bank statements about who paid, who did I pay to, what kind of text was there in a payment, what kind of category was it, etc. And from that, we can actually get quite a high level of accuracy as well.
Yeah, no, fully agree. These 1,000 items were not categories; these were rules actually but still 1,000 rules blew my mind.
Yes.
No, fully clear. Maggie, Alex, Maggie, you first. Should cash flow forecasting maybe not lie with Treasury? Should another department be doing that? We're too small. We don't own the information. Maybe FP&A or accounting should do it.
If I'm being cheeky, because I clearly don't like cash flow forecasting, if someone else would do it and it's good data, actionable data, because Treasury will in the end be the user of that information, right? But if someone else can do it, yeah, I will not say no. But yeah, the thing is, since Treasury is going to be the ultimate user, of that information, they're also best positioned to say, to ask the information from the colleagues, or to look at the information if it's coming from AI, to do a sanity check. If someone else can do the work, collect the information, or hit the button for AI, I don't know what. But if that person doesn't really have some more knowledge, they will not be able to judge whether it is useful or good or not. So it's a mixed answer. If you want to be easy or lazy and say, I don't have the resources, let someone else do it, it's fine. But in the end, you cannot avoid that Treasury, still needs to sanity check the numbers, look at it, know some background to be able to judge whether the information is actionable or not.
No, I fully agree. Alex, short answer, please.
Yeah, I think ultimately the buck stops with Treasury. We are the stewards of cash. Like it or not, if the cash is not there on the account, who is CFO going to ask? And that's going to stop with Treasury. You can't avoid that. So if you're the one responsible for making sure the cash is there, you should be responsible for forecasting where the cash is and planning for it to be there where it needs to be. That's probably as simple as I would put it. How you get there is a different question. But yes, the buck stops with us.
No, fully agree. And that's sometimes the problem. Treasury is responsible but doesn't own the data. And same what Jürgen said, a different solution on the actuals. It drills down to data again. So we're out of time. We talked for 45 minutes. I think we can talk for another 45 minutes on cash flow forecasting. Audience, I hope you learned something new today. I hope we inspired you. I think the answer to our question, cash flow forecasting on trial, is not yes or no. It's not black or white. It's really, do I need a purpose? Do I need a cash flow forecast? And what's the purpose of the cash flow forecast? What's the level of accuracy that I need? What's the level of time commitment I spend on it? Definitely not 2 hours a day, I hope, for you, because then you spend a lot of time on it. Thanks for joining. Thanks for being on the panel, Maggie, Alex, and Jürgen. To the audience, if you want some follow-up, if you need more information, I would say Jürgen is the guy to go to from a tech perspective. He's done a lot of implementations on cash flow forecasting, the ERPs, the AI. Please reach out to him, connect with him on LinkedIn, or reach out to one of us at Treasury Masterminds, and we're happy to talk to you as well. Thanks for joining today. Keep a lookout to our new webinars, which are upcoming, and enjoy the rest of your day. Thank you.
Thank you. Thanks, everyone.
Thanks, everyone. Have a good day.
Take care.